US stocks rise as producer prices drop ahead of tonight's CPI data. China's core inflation rises, meaning the People's Bank of China's easing cycle could be near an end. And New Zealand's traffic data shows the economy may pick up from the third quarter. That's coming up in our 5 Things in 5 Minutes on Thursday, September the 11th. And then in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes says China's build-up of its oil reserves is set to end.
China's always been very long-term in its thinking around commodities, and it's always targeted the ones that they see critical to their longer-term future by restocking at these sort of critical levels.
But first, in 5 and 5 with ANZ, US stocks rose overnight as producer price inflation, or factory prices, fell 0.1% in August, the first fall in 4 months. The surprise comes ahead of CPI inflation data tonight, which will be the last key data before the Federal Reserve's rate cut call next week. As of 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.3% and the Nasdaq was up 0.2%. The yield on 10-year US Treasuries was down 4 basis points at 4.03%. Gold up 0.1% at $3,685. It hit $3,696 an ounce overnight. West Texas oil futures were up 1.9% at $63.83 US a barrel. The US dollar index was flat. The Aussie dollar, though, up 0.5% at 66.23 US cents, while the Kiwi was up 0.3% at 59.48 US cents. Number 2, China's consumer price index fell 0.4% in August from a year ago after several increases. However, core CPI rose 0.9%. ANZ Senior China Strategist Xiaopeng Xing says an improving inflation outlook from here should mean the People's Bank of China is close to the end of its easing cycle.
We expect maximum 20 bips interest rate cut before the end of next year. Growth pressure is also easing. Now the policy focus will be on the rebalance of China economy between domestic consumption and investment. Of course, the fiscal policy will be much more effective than monetary policy in this rebalance.
Number 3, New Zealand's heavy traffic activity fell 1.3% in August and has lost some of its momentum recently, according to ANZ's Trachometer series. ANZ New Zealand Chief Economist Sharon Zollner says, though, that light traffic activity showed some positive signs.
But the good news is that on a per capita basis, particularly, the light traffic perhaps is the one that has the more convincing turn in it. So overall, I'd say this data is consistent with our expectation that the GDP data next week, which is expected to be pretty dire, probably marks the low, and things will improve from here on and as the year goes on.
Number 4, maybe a turning point for New Zealand's falling migration arrivals and rising departures in recent years. Both appear to have shifted direction, with a net migration gain of 13,000 in the year to July, up from just under 12,000 in the year to June, says ANZ senior economist Matt Galt.
We possibly are at the turning point, although it's a fairly muted turning point if we are. We saw net migration of 2,000 people or so in July, and that's a bit above the average of about 1,000 people a month over the past year. So a slight increase, but migration data can be volatile, so it remains to be seen whether that turning point will persist.
Number 5, exports from Taiwan rose more than 34% in the year to August, exceeding expectations. ANZ economist Bansi Madhavani says the driver continues to be semiconductors for AI.
Now, US tariffs did come into force early August, but crucially, semiconductors still remain exempt. This is helping exports. Plus, this is also a seasonally strong period as new gadgets and new phones are launched, and that drives up demand for semiconductors. So for now, it looks like the AI boost will continue to support Taiwan's export outlook.
Bansi Madhavani there. Now, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes takes a look at China's rising oil stockpiles this year, at a time when OPEC was looking to increase production. I asked him, why won't we see quite so much demand from China by the end of the year?
Yeah, well, there's always a bit of a seasonal downturn, but I think in the case of China, we have seen them soaking up as much of that excess oil on the market as possible, in the idea of really building up their strategic reserves. And I think energy security has become a major issue for a lot of countries over the past few years, and China's clearly one of those. those. So the opportunity for, one of the world's largest consumers to build its reserve was something that they couldn't miss, particularly with prices coming back to where they have over the past month or two. Now, I think going forward, though, the economics of their refining industry are looking a little weaker. They're obviously built up a fair stockpile as well. So it's probably a time for pausing for a lot of these refiners, unless I suppose we did see prices continue to push lower, which could incentivise them just to continue to restock.
So what was behind the build-up in the stockpile to start with? Because it's not small.
Yeah, look, I think China's always been very long-term in its thinking around, commodities, and it's always targeted the ones that they see critical to their longer-term future by, restocking at these sort of critical levels. They've before 2025, their strategic reserve was nothing significant on a global scale. So I think it did require some attention, and obviously the opportunity presented itself. But even though it is quite large, they are obviously one of the largest consumers, but don't have the domestic industry to rely on, where other large consumers like the US can rely on in certain times.
Talk to us about these so-called teapot refineries and the economics at play there.
Yeah, well, essentially, the teapot refineries are smaller, independent private refineries in China, i.e., not state-owned enterprises, and they generally are swing producers in the market. They come in and out as economics persist, rather than being dictated to by Beijing itself. At the moment, they've been really struggling in the face of weakening margins. The international market has been quite competitive, and certainly within China itself, due to that restocking. But that looks like it is going to continue to weaken. There's really no sign on the horizon that things will start to improve, and that's going to obviously weaken, I suppose, China's imports over coming months.
So are we there yet? How much could China actually increase its reserves?
Yeah, well, at the moment it is essentially storage capacity, and they've been building that out, for some time now. But I suspect they're coming close to, meeting or reaching sort of those sort of operational levels. They do have, more in the pipeline, and I think, once they become completed, then we'll start to see, potential build up again of that. But for the moment, I think they're coming to that natural sort of ceiling that current capacity entails.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, September the 11th. Catch you tomorrow with what those US inflation numbers tonight could mean for Fed rate cuts. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.